Let me just welcome you all. My name is Max Cameron, and on behalf of the Center for the Study of Democratic Institutions, I'm delighted to welcome you to today's talk by Jeff Rubin. This talk is part of the Policy at UBC series, a cross-campus initiative of the Lew Institute, in whose building we find ourselves. And we're lucky today to be able to piggyback on the David Suzuki Foundation, which in fact brought Mr. Rubin to the West Coast for another activity, so our thanks to them. Just to get us started, I'd like to introduce Jen Allen. She'll be moderating today's discussion and introducing the speaker. Jen is a PhD candidate in the Department of Political Science. She's also the senior writer for the International Institute for Sustainable Development and has attended nearly all of the international negotiations leading up to what we hope will be a climate agreement in Paris later this fall. So let me, without further ado then, hand the floor over to Jennifer, who will introduce our speaker and manage the Q&A afterwards.
Thanks, Max. I think before we begin, I would also just like to acknowledge that we're on the traditional, ancestral, and unceded territory of the Musqueam Nation. I think it's important to remember every day that we're at UBC, but certainly when we're going to have a conversation around natural resource extraction. Now just slightly switch gears. I'm very happy to be able to welcome you all, and I'm very happy that many people managed to come. We have with us one of the world's leading experts on energy. For 20 years, Jeff Rubin was the chief economist at CIBC World Markets. In the mid-2000s, he accurately predicted a rapid rise in oil prices, and his new book, The Carbon Bubble, What Happens to Us When It Bursts, has yet more predictions for what happens to the Canadian economy when the realities of fossil fuel use become even more evident than they are today. So, without any further ado, I'd like to introduce Jeff Rubin.
Thank you very much. I'd like to start off by talking about bubbles. You might remember when you were a kid, take a plastic wand, dip it in some dishwasher detergent, and then make these glistening, effervescent balls that would float up in your backyard and caught in the sunlight. And then just as quickly as they came, poof, they disappear, never to be seen again. Well, bubbles aren't just something that little kids do in their backyards with soap detergent and plastic wands. Bubbles are a common, very common, more common than most people recognize, feature of our economy. And they've always been that for centuries. 15th century Dutch tulip bulb bubble, next century the South Sea bubble. In my tenure as the chief economist at CIBC, I've known three bubbles. Around the turn of the century, we had the dot-com bubble, where all of a sudden stocks like Nortel Networks that were 35% of the value of the TSX disappeared in literally a year, became nothing. Then we had 4 or 5 years later the subprime mortgage bubble that blew up financial institutions all around the world. The financial institution that I was the chief economist of wrote down some $7 billion, others much worse. And now, I believe, another bubble, the carbon bubble. And the one common feature of all of these bubbles is that they're based on some fundamental premise that turns out to be untrue. In the case of the dot-com bubble at the turn of the millennium, it was that, there would be exponential growth in IT sales and that stock valuations of IT companies could be assigned infinite multiples on earnings because these companies were going to grow so exponentially. In the case of the subprime mortgage bubble, it was mortgages held by unemployed households could be deemed as creditworthy by rating agencies as a government of Canada or U.S. Treasury bond. And in the case of the carbon bubble, it's the notion that there is no limit to how much fossil fuels we can combust to drive economic growth. And right now, if you look at the global economy, about 75 to 80% of all the energy used to drive the global economy comes from either burning coal, burning oil, or burning natural gas. Well, there are two fundamental mistakes about the assumption that there is no limit to how much fossil fuel we can combust to drive economic growth. One is an economic limit, another is an environmental limit that in turn has dire economic implications. The economic limit is simply the fact that the very prices that we need to extract high-cost sources of fossil fuels, like, for example, Canada's tar sands, which is the most expensive oil in the world to produce. The problem is that the very triple-digit oil prices that make resources like the tar sands, shale formations, Arctic oil, deep water oil commercially viable translate into the same very prices that kill economic growth and hence the demand for fossil fuels. Let's take, for example, the Canadian tar sands, which today are supposed to be the third largest oil reserve in the world behind the Venezuela tar sands and Saudi Arabia's deposits of conventional oil. The tar sands are not a new discovery. As early as 1920, there was a pilot plant that tried to extract bitumen from the tar sands. But they were, for decades and decades, a neglected resource. And it wasn't because people didn't realize how much oil was buried under the Alberta muskeg. People knew that there were billions of barrels of oil. There's something like 170 billion barrels. The reason it was neglected for commercial development was because the cost of extracting that oil from the oil sands didn't make any commercial sense. In other words, the cost of extracting the oil was greater than the price of oil. So who was going to bother sinking capital to develop that? And so for decades and decades and decades, the oil sands or tar sands weren't even considered an oil reserve, because an oil reserve isn't just about geology, it's about economics. It's about whether this reserve can be commercially extracted. Until, of course, about the 1990s, 2000. And what happened then? Well, what happened then is oil prices started to rise. And oil prices started to rise not because of anything that was happening in the Middle East, not because of any kind of curtailment of supply. Oil prices were rising because the cheap oil that had powered the world economy, the oil from Saudi Arabia, Iran, Iraq, the conventional oil, it wasn't growing anymore. And contrary to what you may hear in the media about how OPEC has opened up the spigots to marginalize North American oil production, conventional oil production, OPEC, peaked in about 2005. And that meant that as the world economy continued to grow and needed more and more oil, that we had to find oil from new places. And the new places that we were looking for oil wasn't in OPEC, it was in unconventional oil. It was oil buried under the sea. It was oil in shale formations. And it was oil trapped in the oil sands. And all of a sudden, the oil sands went from this marginal, neglected resource that people knew about but didn't think was commercially viable to all of a sudden one of the hottest oil plays in the world, where it wasn't just Canadian capital, it was capital from all around the world was invested in the Alberta oil sands. And as oil prices started to rise from $30 to $50 to $70 to $100 and all the way up to $147 a barrel before the last recession, all of a sudden this marginal resource became the darling of the world oil industry. One of the reasons it became the darling of the world oil industry is that unlike most places in the world, North America is one of the few places where private firms can develop oil. Private firms like Sunco or Exxon, they can't go into Saudi Arabia. The oil production of Saudi Arabia is Saudi Aramco, a national oil company. But it's not just the Middle East. Even Mexico, oil was nationalized and Pemex was the national oil company. So a firm like Exxon or Shell couldn't invest. In Venezuela, which has a bigger oil sands than Canada, Exxon plowed billions of dollars in until Hugo Chavez all of a sudden nationalized them. And probably, although most people in Alberta wouldn't recognize this, Hugo Chavez did more to help the Alberta oil industry than probably any single individual. Because by driving Exxon and Shell and Total out of Venezuela, which has a similar resource to the oil sands, guess where they ended up going? They came here. And shortly after the expropriation of Exxon in Venezuela, Exxon gave the green light to its Canadian subsidiary, Imperial Oil, to develop the giant Kearl Lake mine, which is the biggest project that Exxon has going on anywhere in the world. So the combination of we were open to private investment and triple-digit oil prices all of a sudden made this marginal resource into the third largest oil reserve in the world. And production started growing exponentially from 300,000 barrels to all of a sudden 1 million barrels. And then production doubled to 2 million barrels a day. And all of a sudden Canada, which was always a sort of mid-tier oil producer of conventional oil in the Western Sedimentary Basin in Alberta, started to have like OPEC-like numbers. All of a sudden Canada was in like the top 5, 6 oil producer in the world. But the problem was that the very triple-digit oil prices that turned this marginal resource into the third largest oil reserve in the world and catapulted Canada into the front ranks of oil production killed economic growth. I mean, we have now 7 years of experience with these prices, and the problem is that the world economy does not run well with triple-digit oil prices. I mean, it does wonders for Fort McMurray in Alberta, or for the Bakkens in North Dakota, or for deep water oil. It makes all of these places commercially attractive, but it kills economic growth. And if you doubt that, just look at what's happened in the last 7, 8 years. The 2008 recession that followed on the heels of $147 a barrel oil is the deepest recession we've had in the post-war period. And moreover, the economic recovery since then has been the weakest on record. So that's the fundamental problem, is that the very triple-digit oil prices that bring the supply out of the ground kill the demand side and kill economic growth. And since oil is the most important fuel driving global GDP, when you have weak global GDP or worse, a recession, obviously it hammers oil prices. Now, that's a pretty formidable economic constraint in and of itself. But there's an even more formidable economic constraint that looms ahead in the future. And that's the environmental constraint, that we have now crossed over 400 parts per million carbon in the atmosphere. The world scientific community has been telling us for quite some time that we cannot allow carbon to continue to build in the atmosphere, that the atmosphere cannot be viewed as a garbage dump for carbon emissions, because if we do that, the increase in carbon in the atmosphere is going to raise global temperatures to levels that are potentially cataclysmic for many regions of the world. The consensus has been that we have to stabilize carbon at about 450 parts per million, and even with that, we're going to get about a 2-degree rise in global temperatures. We've already had slightly under 1. If we don't, if we go on with business as usual and continue to rely on coal, nat gas, and oil to power global economic growth, that we're not going to see a 2-degree rise in temperature. We're going to see anywhere from a 4 to 5 degree rise in temperature that would have, for many areas of the world, particularly the 700 million people who live in coastal populations, including Vancouver, cataclysmic consequences from rising sea levels, not to talk about the drought in major agricultural areas and the increasing challenge of feeding what is now 7 billion, what will be then 9 billion people. So, if it's not business as usual, if we're going to draw the line at 450 parts carbon, what does that imply about the future trend of consumption of fossil fuels? Well, that's a very interesting question, and one that the International Energy Agency, which is probably the world's authority on energy usage, modeled back in 2012. And they calculated that if we are going to stabilize carbon at 450 parts per million, then in the next 2 decades, world coal consumption would have to fall by roughly 1/3, and world oil consumption would have to fall from today, right at 93 million barrels a day, to about 80 million barrels a day, or about 15%. Well, that's a very different world than what you would find in the prospectus of a coal company or an oil company. They would tell you that, that we're going to continue to see steady increases in world oil consumption and world coal consumption. What happens if we're facing declines? And let's just put those declines in perspective. During the Great Recession, where oil prices went from $147 to $40, there was a 3.5% decline in world oil consumption. We're talking about a 15% decline in world oil consumption. And in the recession, that was even the deepest recession is a temporary 5-6 quarter phenomena, and oil consumption came right back. We're talking about no comeback in world oil consumption, a permanent decline. Well, what are the consequences of that? Okay, today when you turn on the media, read the Globe and Mail, Wall Street Journal, CBC Business Report, they would have you believe that the decline in oil prices is because Saudi Arabia and the Middle East have opened up the spigots and are pumping out more than ever to wipe out North American oil production. Nothing could be farther from the truth. OPEC is producing the same 30 million barrels a day that they've been producing in the last 5 years. There's been changes within OPEC, big increases in Iraqi production. Iran, of course, is under the sanctions and haven't been able to produce as much. Saudi's producing more or less the same 10 million barrels a day. And you know why? It's because that's all they can produce. They've already maxed out. I mean, they maxed out way back in 2005. That's why we have an oil sands. That's why they are fracking formations in the Bakken in North Dakota. And that's why we're drilling deep water wells, is because OPEC can't provide anymore. Where has the increase in production come from? Guess where the increase in production has come from? It's come from right here, North America. And of course, up until a couple of years ago, that was trumpeted, that we're no longer going to be dependent on hostile regimes like big bad Hugo Chavez in Venezuela or unstable countries in the Middle East, that we're going to be able to be self-sufficient in oil because of all this oil that we're now getting from shale formations and from the oil sands. But the reality was that energy independence was based on very high oil prices, because you need very high oil prices to be able to frack shale formations and get oil, or to be able to scoop up 2 tons of oil sands to get a barrel of oil, okay? You don't do that if there's conventional supply available. The problem was there's no longer the growth in conventional supply. All of the increase has been us. And now we have a glut in the oil market. We have more oil than is being demanded. But the culprit is not OPEC. The culprit is us. But we don't want to recognize that, because to get the recovery in oil prices that are needed to make the oil sands and other high-cost sources of supply commercially viable, they have to cut production, not increase production. It's not the low-cost producer. It's not Saudi Arabia that needs to cut production. Sure, Saudi Arabia was making a lot more money when oil was $100 a barrel than when oil was $40 a barrel. But even at $40 a barrel, Saudi and Iraq are making money. At $40 a barrel, the oil sands are not making money, and neither are the shale formations. And in the market, it's the high-cost producer, not the low-cost producer, that has to exit the market to get a price recovery. Now consider the implications of the carbon constraint. I mean, if I'm here representing the oil companies, I would say, yes, Jeff, we can't make money at today's oil prices, but every time that we've seen a decline in oil prices, we've seen a huge rebound in oil demand. But the scientific community is telling us that there can't be this increase in world oil demand, that it can't be business as usual, because if it's business as usual, we're going to see carbon go way above 450 parts per million, and we're going to have to deal with these environmental events that have huge economic consequences. So, what's the future for the oil sands? At today's oil prices, the oil sands has no future. At today's prices, the oil sands is not commercially viable, because not only is it the highest cost oil in the world, but it has the double problem of getting the lowest price in the world. When you turn on your television or read the paper and you see that oil today is trading at $45 a barrel, you may think that's what the oil sand producers get. That's something they dream of getting. The price that they get is a price that's never reported in the Canadian business media. It's called Western Canadian Select. Western Canadian Select is the benchmark price for heavy oil that comes out of the Alberta oil sands. Western Canadian Select today is trading at a $17 a barrel discount to world oil prices. The price that oil sand producers are getting today for their oil is something in the neighborhood of $27 to $28. The cost of new supply from the oil sands, all these projects that we're going to double oil sand production in the next 10, 15 years, is $60 to $80. That doesn't make any economic sense. Despite what you may hear about pipelines, pipelines no longer have an economic context, because the very projects that were going to supply these pipelines, whether it's Northern Gateway, Trans Mountain, whether it's Keystone XL or Energy East, all of these pipelines were to accommodate this doubling of production. But in the last year and a half, you've seen already over $20 billion of projects canceled. These were the very projects that were going to supply these pipelines. So while the pipelines have got regulatory approval from the National Energy Board, which is no surprise, since when has the National Energy Board ever not approved a pipeline? Let me point out that National Energy Board approval is a necessary but not sufficient condition. You've got to be able to finance these pipelines in the marketplace. And in order to finance these pipelines in the marketplace, they've got to make economic sense. There no longer is an economic context for a doubling of production. There no longer is an economic context for the pipelines. But there's worse yet to consider. Not only do today's oil prices leave no room for an expansion of production, but today's oil prices, if they continue at this level, let alone decline further in a decarbonized future, means that it's not going to be sustainable to produce 2 million barrels a day, which we're right now producing. Right now, they're hemorrhaging red ink to produce that money. There isn't an operator making money at today's prices. Now, if Suncor was here, or Cenovus, or Canadian Natural Resources, they'd say, that's true, Jeff, but we're going to see a big rebound in oil prices in the future. Well, that rebound is looking more and more improbable, and to the extent that the global economy is going to decarbonize, that rebound becomes impossible. At the beginning, I said there were bubbles. Canada, for the most part, escaped the worst of the dot-com bubble. I mean, we had Nortel networks, but compared to what happened in California, that was small stuff. I said that notwithstanding the write-downs that my former bank and some others did, Canada really was not hurt badly by the subprime mortgage bubble like other countries and financial institutions. But when it comes to the carbon bubble, we're right at the epicenter of that bubble, because we have defined the oil sands not only as a sustainable project, but as the engine of economic growth. In fact, it was only a year ago that the Globe and Mail was likening the oil sands to the building of the Transcontinental Railway that made Western Canada possible to join Confederation. They said it was a game-changing event, not just for Alberta, but transformative for the whole economy. That we were going to have Saudi Arabia-type revenues that through the federal tax transfer system would be spread across the country. Well, since then, we've gone from engine of global economic growth to epicenter of a made-in-Canada recession. Because in the first 2 quarters of the year, GDP in Canada shrank, and that wasn't because of some global recession, because GDP shrank for virtually one reason: the huge collapse in capital spending in the oil sands. And while we don't have provincial data, provinces don't publish quarterly GDP numbers like the federal government. You know, we know from a number of indicators that Alberta's recession is not mild. Alberta's going through one of its deepest recessions in the post-war period, because this engine of economic growth has turned out to be a huge economic liability. And in a world of decarbonizing economies, is really a stranded asset. Now, to what extent that's been recognized in the upcoming election and by other parties is questionable. Obviously, the Harper government that has banked the nation's economic future on the oil sands is very vulnerable, and Harper has always campaigned on his economic management strength. Well, a made-in-Canada recession caused by a huge implosion of capital spending in our so-called engine of economic growth obviously is a political liability to the Conservative government. But not to be partisan, you know, I think that the opposition, both Mulcair and the NDP, have not yet really come to terms with the nature of the problem. I mean, this isn't about adjusting corporate tax rates. This isn't about running trivial budget deficits. This is about a huge misallocation of capital, that we've put our eggs in the wrong basket. And, you know, in the economy, unlike the stock market, in the stock market, you can move capital from sector A to sector B in a nanosecond. You just sell your oil sand stocks and you buy tech stocks or manufacturing stocks. In the real economy, You can't just take billions of dollars sunk in an oil sand mine and all of a sudden turn it into an auto plant. It takes a much longer period of time for the economy to readjust than it does in financial markets. And that's the nature of the problem. The nature of the problem is that we've bet the house on a resource that the rest of the world is shorting. And no policy, no government is going to be able to change that. What is going to change that? Well, there's a term in finance called mean reversion. And what it basically says is that when things, like an elastic band, when you pull it out to its extremities, it snaps back. When you have a huge distortion in one direction, things move the other way. Well, in the last 10 years, we've had some huge distortions in the economy. All of a sudden, we've concentrated all of our investment in the oil sands. The Canadian dollar morphed into a petrol currency because our trade and investment became so centered on the oil sands that our dollar rose with the price of oil, to the point where we went from 61 cents against the US dollar in 2002 to $1.07 in 2007. And in fact, it was only 2 years ago that we were at a parity exchange rate. The Canadian economy does not operate at those exchange rates. The oil sands could, because they were getting US dollars anywhere for their oil. So we saw, in the shadow of the oil boom, huge declines in other parts of the economy. Ontario, the province that I'm from, became a have-not province. Newfoundland became a have province because of what higher oil prices meant for the offshore oil industry. Saskatchewan, Alberta, the delineation between the haves and the have-nots was all about who had oil and who didn't have oil. And what really hurt Ontario and Quebec the most wasn't so much that we didn't have oil. It was that the petrodollar was taking the currency to levels that made huge swaths of the Ontario and Quebec economies uncompetitive. And we lost about 500,000 jobs. Well, the solution here is the currency going the other way. And always in resource booms and busts, and Canada has always been subject to the vagaries of resource cycles, the great safety valve has been the exchange rate. That when commodity prices, and in this case oil prices, collapse, so does the Canadian dollar. We've gone down to 75 cents. I think before all is said and done, we'll be trading at 70 cents or lower to the US dollar. And all of a sudden, these industries that were marginalized, like manufacturing, like film production in Vancouver and Ontario and Toronto that had to struggle with a parity exchange rate, all of a sudden, these are the industries that are coming back. And economic growth is once again shifting to the non-oil provinces. And economic growth is now starting to come, not from the resource sector, but from the other sectors of the economy that were severely damaged by the appreciation of the petrol currency. So, I think in some sense, we are on the mend here, and it's not about policies or governments. It's really about our safety valve has really been the currency, and I think that we're going to see huge swaths of the economy come back. Now, let me just talk a little bit about financial markets, and I want to talk a little bit about divestment from oil sands. Not only is oil a huge part of the economy, it's a huge part of our stock market. In fact, when I was at CIBC World Markets in 2009, the energy sector was the second largest component of the TSX, about 31%. It's about 20% now. So when you buy the Canadian stock market, you are buying a lot of very high-cost, vulnerable oil. Now, institutions around the world, university endowment funds, religious organizations, charities, there's a growing movement to divest from fossil fuels, from coal, from oil. University of California, Stanford University. And of course, the motivation for divestment has always been on moral grounds. In the same way that decades ago, these institutions divested from tobacco, these institutions divested from South Africa during the apartheid regime. And so it was always motivated by some moral concern. And when it came to divesting from oil, what they had to contend with is the perception that when you allow your conscience to be your portfolio manager, it's going to cost you in return. That if you want to divest from carbon stocks and oil stocks, it's going to hurt your portfolio. That if you want to do it, go right ahead, but this is purely a moral decision that you're making, and you're going to pay, at least in the short run, a financial cost. Nothing could be farther from the truth when it comes to divesting from Canadian oil sands stocks, because Canadian oil sands stocks have been the worst performing component of the Toronto Stock Exchange for a number of years. So this isn't just about saving the world. This is just as much about saving your portfolio. Oil sands stocks have lost 80% of their share value since the peak of oil prices in 2008. Oil sands stocks in the last year have underperformed the TSX by over 40%. And oil sands stocks are probably the single number one reason why the Toronto Stock Exchange, which is the benchmark equity index for Canada, has so underperformed other indices in the world, like the S&P 500, that only has half of the weighting. So in this particular case, there are equally compelling reasons to divest from oil sands stocks, quite apart from what institutions may feel is their moral responsibility. Let me give you an example about divestment. Last year, Stanford University, which has a $20 billion endowment fund, divested from coal stocks for the same reasons that people would want to divest from oil sands stocks: principal source of carbon emissions, global climate change. And that was the official reason that Stanford University gave for divesting it. But what Stanford University didn't point out was that the stocks that it was getting rid of, Peabody Energy, Alpha Resources, Arch Coal, the biggest coal stocks in the US market, had already lost 90% of their share value. And in fact, most of these stocks were no longer investment grade. To be held in an institutional portfolio like a university pension plan, a university endowment fund, or a pension plan, you have to be rated BBB+ or above. The fact of the matter is that none of these coal stocks even met that rating. Wouldn't it have been better if Stanford University excluded its coal stocks before they lost 90% of their value than after they lost 90% of their value? Well, if you look at oil sands stocks, I don't think the future of oil sands stocks is any brighter than the future of coal stocks. Wouldn't it be better to divest now before these stocks lose the little bit of value they still have, before they're downgraded by the rating agencies so they won't even be eligible to be held in your portfolio? I would argue the future is now, that the time to divest from carbon stocks is not in 10 to 20 years. The time to divest from carbon stocks is today. Because if you think that carbon stocks are a poor performer today and coal and oil sand stocks have just been absolutely decimated, how do you think they're going to do in the future when the world economy has to cut its coal consumption by 33% in the next 20 years and cut its oil consumption by 15%? It's not Saudi Arabia who's going to be shut in. The Middle East is the lowest cost supplier. It's the high cost suppliers that are going to be shut in, and at the apex of that cost curve is the oil sands. Let me give you another example. Shell Oil just got from President Obama permission to drill in the Chukchi Sea off the Alaskan coast, Arctic drilling. Guess what? They just abandoned the project. They didn't abandon the project because they were concerned about a Deepwater Horizon disaster in the Arctic. They abandoned the project because at $45 oil, drilling in the Arctic makes no economic sense, and shareholders in Shell were not going to support that. Well, by the same token, drilling in the oil sands, building oil sands mines doesn't make any economic sense. And the ultimate arbitrator or policeman here is going to be the market. Because if you can't raise capital, then you can't mine. In fact, I would say the real challenge in Alberta is not just the loss of future production. The real challenge for Alberta is that in the future, they're going to have to close in some of these oil sand mines. And no one's really considered the cost of doing that. All those slag ponds, tailing ponds, stacks of sulfur, they just don't reclaim themselves. I mean, over the fullness of time they would, but not within a time frame that anybody would consider acceptable. It costs billions of dollars to reclaim those mines. Who's going to pay for that? In theory, Alberta oil sand producers pay into this Environmental Protection Fund. But this Environmental Protection Fund carries less than 1/10 the cost of reclaiming an oil sands mine. Now, the oil sand industry would say, you can't ask us to put more money into that fund now. You can't kick us when we're already down. But that's exactly when you got to be concerned. When oil's like $100 a barrel, you don't have to worry about decommissioning an oil sands mine. When oil's $27 a barrel, like Western Canadian Select is, that's exactly when all of a sudden people walk away for those resources and leave the public sector with the mess. So, I've talked a little bit about oil, climate change, what it might mean to the Canadian economy. Let me just end up by talking about the promise of climate change. Obviously, climate change is going to devalue our hydrocarbon resources, and none more so than the high-cost oil sands. But climate change is going to make other resources a lot more valuable, and none more so in Canada than its abundance of fresh water and its agricultural land. Growing seasons on the Canadian prairies are already 26 days longer than they were only 50 years ago. When we're talking about 2-degree changes in global temperature, that's the global average. When you talk about what it means for the Canadian prairies, you're talking a multiple of that. You're talking about 4 to 5 degrees. You change the temperatures 4 to 5 degrees, all of a sudden you change growing seasons. And when you change growing seasons, you change what you can grow. An acre of farmland in Manitoba, Saskatchewan, Alberta trades at about 1/5 the value of an acre of farmland in southwestern Ontario, and about 1/10 what an acre of farmland would be in the Corn Belt in Kansas and Nebraska. And that's because farmland reflects the value of the crops that you grow every year. The Canadian prairies have always been extremely fertile, but because of the shortness of the growing season, you grow wheat and canola. You don't grow corn. Guess what? That's starting to change. And maybe that's escaped the attention of the Prime Minister's office, because you can't, on one hand, talk about the promise of global climate change on agriculture, and then on the other hand, deny any relationship between carbon emissions and global climate change. But it sure hasn't escaped the attention of Monsanto or DuPont Pioneer, the big seed companies. For the last 5 years, they've been holding clinics on the western prairies, telling wheat farmers how to all of a sudden grow corn, and have been spending billions of dollars on developing hybrid corn for the Canadian prairies. Because not only does turning up the thermostat 2 to 3 degrees allow you to grow corn where you've never been able to grow it before, but you turn the thermostat up 2-3 degrees in Kansas in Iowa, in Illinois, in Nebraska, in the U.S. Corn Belt, you get a very different impact on agriculture than you do on the Canadian prairies. We got a taste of that in 2012 when the worst drought in 70 years devastated U.S. corn production and sent corn prices up 50%. All of the scientific modeling on climate change says that world food production is going to have to migrate to high latitude regions. And in fact, NASA, the US Space Agency, has identified the Canadian prairies as a climate change hot zone where you're going to see profound changes in ecology of fauna and flora. Not all of them positive, the pine beetle, Lyme disease ticks. A lot of nasties are going to get a passport to go to high latitude countries where they never had before. But in terms of agriculture, I think it creates enormous potential. That instead of being the energy superpower as dreamed by our leaders, I think Canada is going to become one of the world's primary breadbaskets. And when you compare how food prices, even today, have stacked up against oil prices, I think that's going to be a very value-added change to make. Well, thank you very much, and I'll throw it up to discussion or questions. Thank you.
Thanks, Jeff. There's certainly a lot there. I think you managed to hit climate science, climate economics, and election diversification, oil forecasting, consumption pipelines in a very brief time.
Did my best.